what they call guaranteed term. You can get capital protection. You can get annual increases. You can get spouse income.
Disclaimer. Be informed, this video or audio is created for financial education purposes only. It doesn't form or it is not intended to form a financial advice. Should you need a financial advice, please go to FSCA registered financial advisor or planner or consultant.
Welcome to BluFinance TV. My name is Ayanda. On today's episode, I will be talking about the retirement stage. First of all, before I continue with talking about the retirement stage, let me mention the stages that you have when you are doing your retirement. We have pre-retirement stage where you're doing all the contributions towards your retirement, annuities, pension fund or provident fund, where you're doing all the transfers to your preservation fund because you don't want to use that money. You will use it when you retire. At the second stage, which is the retirement stage. At the retirement stage, it is when you're making a decision on how much you're going to be using to buy your retirement annuities. You actually need to withdraw that 1/3 from your preservation fund, from your retirement annuity, from your provident fund. That is where you make all those decisions. And the last stage, which is the post-retirement plan. On the post-retirement, it is when you're reaping all the rewards, where you're receiving all the annuities, where you make some changes on your annuities. For example, if you have a living annuity, where you're making all the changes on your drawdowns. That is the last stage of retirement planning. Okay, now we are assuming that you are retiring as you have reached the retirement stage and you're deciding that you want to retire with your retirement annuity, your provident fund, your pension fund. You have two options. It is either you retire within a fund. There are funds that allow you to retire. You can withdraw your 1/3 and buy compulsory annuities within the fund. Or maybe you take your fund to a third party, a company where you're going to buy your compulsory annuities with it and also be able to withdraw your 1/3. Let us assume that you're retiring within a fund. The only option that you have when you retire within a fund, you can withdraw your 1/3 and then you will be able to buy compulsory annuities within that fund. Now you are taking your money outside the fund that you have been contributing towards during the years of your employment, and now you decide to buy annuities with another insurance company, another asset management company. In that case, you will use your money, which is going to be 2/3 to buy compulsory annuities, and you also allowed to withdraw 1/3 from that money. That 1/3 is going to be taxed according to your retirement tax table. And when it comes to the annuities that you are withdrawing, they're going to be taxed according to your marginal tax rate. That means if it is 40%, you're going to be taxed 40% of those annuities. If you decide to retire and you don't want to use your employer's pension fund or provident fund to buy annuities, you also have an option of using investment companies to assist you or insurance companies. When you get there, you may have two options. One could be life annuities. The second one, living annuities. Let us say you're taking a life annuity. With a life annuity, there are rider benefits that can be added on your product depending on the insurance company that is assisting you. With some insurance companies, you can get what they call guaranteed term. You can get capital protection. You can get annual increases. You can get spouse income. With capital guarantee, that means if you pass away, there's a guarantee that your family is going to get a lump sum from that insurance company. You can cover up to 100%. In some insurance companies, you can cover up to 75%. But you must remember that you are paying a premium for that capital guarantee because it is a life cover, but it is embedded in your life annuity. Let us say you're taking a life annuity. With your life annuity, you don't want to take any rider benefit on top of it, and then you pass away after 2 years. What will happen to your money? You're going to lose everything. Nothing's going to be paid out because you don't have capital protection, you don't have income guarantee, you don't have spouse income. Let us look on scenario 2. On this scenario, you have life annuity with income guarantee of 10 years. In this case, if you pass away within income guarantee term, your family is going to get a total of annuities that you are still going to get paid Let us say you pass away after the end of second year. That means your next 8 years is going to be put together as a lump sum and be paid to your beneficiary. But if you pass away after 10 years, your family is not going to get anything because you do not have a capital protection on your life annuity. Now let us look on that scenario. In this scenario, you have life annuity with 50% capital protection, and then you pass away after 2 years or after a month, you have taken your life annuity. What will happen to you? In that case, your beneficiaries are going to get 50% of your initial investment to your life annuity. But if you did not have that capital protection of 50%, your family was going to lose everything. That means even your estate was not going to get anything from your life annuity. Now let us look on last scenario. In this scenario, you have life annuity, you have a 10-year income guarantee, you have 50% capital protection, and then you pass away after 3 years. What will happen in that case? In that case, your family will get a lump sum of capital protection, which is going to be 50% of your initial investment. They will also get an income of the remainder of years. You passed away after 3 years, that means it is going to be 7 years. The income of 7 years is going to be put together as a lump sum and be paid to your beneficiary, and also the capital protection that you had of 50%. Let us say now you pass after 10 years. What will happen in that case? If you pass after 10 years, your family is not going to get a lump sum based on income that you have been receiving. It is only gonna be your capital protection of 50%. If your money was 1 million, that means 500,000 is gonna be paid to your beneficiaries. Okay, now we are moving on to look on a second option, which is a living annuity. With a living annuity, we have a drawdown percentages that you can use. The drawdown is an income that you can be able to withdraw from your initial investment. The minimum is 2.5% per year. The maximum is 17.5% per year. You can only be able to review after 12 months. It is only then you can be able to change the percentage to whatever percentage you want, provided it is not going to be below 2.5 or above 17.5%. When we are taking living annuities, you also need to understand returns of your underlying investment, and also be mindful of your drawdown percentage, because in some cases your investment may be doing 6% and you want to draw at least 9%. That means in that case, the 3% extra above that 6% of investment performance is going to be taken from your capital contributions on the money that you have put into your living annuity. That is why it is important for you to understand how is your underlying investment performing, so that you're going to be able to align your drawdown with investment. In most cases, some people, they rather have their drawdowns below the returns of investment. That means if it is 6%, they may choose maybe 3% or 4% because they don't want to deplete their capital. You don't want to outlive the capital that you have invested, because if you outlive that capital you have invested, you're not going to have income in a long run. That is why it is very important for you to understand how your underlying investment is performing. Ask your financial planner if you don't understand it, and make sure that you're attending each and every review that your financial planner has set up for you. If you don't attend those reviews, there might be something important that your financial planner would like to share with you, but if you are not there to listen to your financial planner, how are you going to know how your investment is doing? How are you going to know that your drawdown is affecting your investment, especially your capital? Because you don't want to lose the capital you have invested. You don't want to outlive your investment. The last option that I want to talk about, it is having both the life annuity and living annuity. You are able to do that. That means you may take 50% by life annuities, take 50% by living annuities. You know, on your life annuities, you're getting all the rider benefit, which can be capital protection, income protection, spouse income. On the other side of a living annuity, you're using the drawdown that you think it is suitable for you. You're doing whatever it takes to protect your capital. Thank you for watching. Please like, subscribe, and comment below.